The company, Singapore and Straits Aerated Water Company, was formed in 1883 by John Fraser and David Chalmers Neff. In 1898, a new public company was formed and the two businesses were sold to the new company named Fraser and Neff, F&N. In 1931, Fraser and Neff formed a joint venture with Hollands Heineken to venture into the brewing business. In 1936, F&N acquired the Singapore, Malaya and Brunei franchise rights for Coca-Cola. The company went on to acquire the rights for other PepsiCo, Coca-Cola and Cadbury Schultz brands. In 1990, Malayan Breweries changed its name to Asia Pacific Breweries. In 1999, F&N purchased a 20% stake in Times Publishing before taking majority control of the company in 2000. In 2006, the Singapore Government Investment Company, Temasek Holdings, took a 14.9% 900 million stake in F&N. In 2008, F&N organized its management structure and appointed a chief executive for 3 of its core businesses. F&N Singapore launched a new logo for its food and beverage business in order to reach the Asia Pacific market. In 2010, Temasek's entire stake was sold to Japan's Kirin Holdings for 1.33 billion. On 1 September 2011, the 3/4 century partnership between F&N and Coca-Cola in Malaysia, Singapore and Brunei ended. In July 2012, Thai Beverage acquired a 22% stake in F&N from Overseas Chinese Banking Corporation, raising its stake to 24.1%. In August 2012, F&N accepted an offer from Heineken to acquire its stake in Asia Pacific Breweries for 4.1 billion. Thai Beverage and its partner TCC Assets, both controlled by Thai-Chinese billionaire Karen, made a move to thwart efforts by Heineken to acquire control to Asia Pacific Breweries. Other companies, such as Coca-Cola and Kirin Holdings, has also shown interest for the soft drink and food businesses of F&N. In 2013, Kirin Holdings sold their 15% stake in F&N to TCC Thai Beverage.
Illiquidity ratio. There are current, quick ratio and net working capital. The current ratio of F&N Holding Berhad in 2018 is the highest compared to 2017 and 2019. This indicates that in 2018, the F&N Holding Berhad has enough current asset to pay for its current liabilities compared to 2017 and 2019. The quick ratio of F&N Holding Berhad in 2018 also the highest compared to 2017 and 2019. This indicates that the firm has enough current asset to pay for its current obligation in 2018 compared to 2017 and 2019. Lastly, for the net capital working of F&N Holding Berhad in 2017 show the lowest value compared to 2018 and 2019. This indicates that in 2017, the F&N Holding Berhad has insufficient margin of safety and will not be able to meet its short-term obligation compared to 2018 and 2019. In activity ratio, there are inventory turnover, average collection period, fixed asset turnover and total asset turnover. The inventory turnover for F&N Holding Berhad in 2019 is the highest compared to 2018 and 2017. This indicates the F&N Holding Berhad in 2019 is efficient in using its inventory to generate sales compared to 2018 and 2017. The average collection period of F&N Holding Berhad in 2019 is the lowest value compared to 2017 and 2018. This indicates the F&N Holding Berhad for 194.4 days to recover back the cash from its credit sale. Fixed asset turnover of F&N Holding Berhad in 2019 is the highest compared to 2017 and 2018. This indicates the efficiency of F&N Holding Berhad to manage its fixed asset to generate sale in 2019 compared to 2017 and 2018. Lastly, total asset turnover of F&N Holding Berhad in 2019 is the highest value compared to 2017 and 2018. This indicates that the efficiency of F&N Holding Berhad in using all its assets to generate sales compared to 2017 and 2018.
In leverage ratio, there are debt ratio, debt to equity ratio, and time interest earned. Comparing the years between 2017, 2018, and 2019, the debt ratio is increased from 2017 0.15% to 2018 147% and decreased to 27.8% in 2019. It indicates that 147% of the Fraser and Neves assets are financed by borrowing. High borrowing indicates high interest payment. The higher the percent, the higher the risk. Next, debt to equity ratio increased as the year increased. Debt to equity ratio for both 2017 and 2018 are 0% and increased in 2019, which becomes 7.1%. It indicates that 7.1% of the FNN in 2019 are from borrowing. FNN's capital has debt. Time interest earned increased as the year increased. Time interest earned for 2017 and 2018 are undefined, and time interest earned for 2019 has 7.1%. It indicates that for every 1 ringgit interest borne by FNN in 2019, it has 47.1 times of earning before interest tax to pay for it. Increasing the year for 2017 to 2019, the earning before interest tax increased. So, FNN does have enough margin of safety. In profitability ratio, there are gross profit margin, operating profit margin, net profit margin, return on assets, and return on common equity. Comparing the year from 2017, 2018, and 2019, gross profit margin decreased as the year increased. Gross profit margin for 2017 and 2018 has same value, which are 100%. It indicates that for every 1 ringgit sales, Fraser and Neves is making profit of 100% after deducting direct costs. The higher the gross profit margin, the better. Operating profit margin decreased as the year decreased. Operating profit margin for 2017 are the highest with 99.66%. Operating profit margin for 2018 has 1.13% and for 2019 has 7.8%. It indicates that for every 1 ringgit sales, Fraser and Neves is making a profit for 99.66 cents in 2017. 1.13 cents in 2018 and 7.8 cents in 2019 after deducting direct and indirect costs. Next, net profit margin decreased as the year increased. Net profit margin is the ratio of net profits to revenues for a company or business segment. Net profit margin for 2017 are the highest with 103.23%. For 2018 has 102.7% and for 2009 has 11.6%. It indicates that for every 1 ringgit sales, Fraser and Neves is making a profit for 99.66 cents in 2017, 1.13 cents 2018, and 7.8 cents 2019 from after deducting direct and indirect costs. Next, return on asset for 2018 record with the highest return on asset, which is 27.5% compared to 2017 with 23.31% and 2019 with 3.7%. It indicates that for every 1 ringgit invested in the assets, Fraser and Neves is able to generate a profit of 23.31 cents in 2017, 27.5 cents in 2018, and 3.7 cents in 2019. The return on total asset ratio indicates how well a company's investments generate value, making it an important measure of productivity for a business. Return on common equity for 2018 record the highest with 23.35% compared to 2017 with 27.5% and 2019 has 5.1%.
The company began as Pacific Milk Industries Sanjaya Berhad on 28 May 1963, where it was commissioned to manufacture sweetened condensed milk in its factory in Petaling Jaya, becoming Friesland Foods' first production facility outside the Netherlands. It was formed as a private joint stock limited company and began with the manufacture of only condensed milk before expanding into dairy products. Many of its goods started to be shipped to neighboring countries in Asia and Oceania prior to the expansion. The company became the first milk company to be listed on the stock exchanges of Kuala Lumpur and Singapore on 24 September 1968 and changed its name to Dutch Baby Milk Industry Berhad in 1975. After the modernization of the company, it changed its name to Dutch Lady Milk Industries Berhad in 2000s, and since the 1970s, It has been using ultra-high temperature processing and packaging technology to produce milk in the region. Sterlast milk was locally produced and sold in plastic bottles in 1983. Production of chilled milk products began in 1986, and fruit yogurt and rising milk were introduced to the market in 1988. The company continued to manufacture and introduce new products into the Malaysian market. In 2011, with the Dutch Lady brand holding 40% of the national market share, Dutch Lady Malaysia was reported as the market share leader in the growing milk segment, with a net profit of 27.5 million. Its financial record for the first quarter of 2012 showed a 9% growth in sales year on year. Dutch Lady Malaysia was reported to be on track to meet its 1 billion sales target for 2013, amid a slowdown in the Malaysian dairy industry.
The analysis of Dutch Lady milk industry Berhad, the firm current ratio is 1.1, where the highest current ratio the better. If the firm current ratio is higher than industrial average, this indicates the firm has enough current asset to pay for its current liabilities. The firm quick ratio is 0.6 times, where the higher the better. If the firm ratio is higher than industrial average, this indicates that the firm has enough current asset to pay for its current obligation. As we can see, the firm net working capital is 22,417,000, where the highest positive the better. If the firm ratio is higher than industrial average, this indicates that the firm has sufficient margin of safety and will be able to meet its short-term obligation. The firm inventory turnover is 4.9 times, where the higher the better, but not too high. If the firm ratio is higher than industrial average, this indicates the firm is efficient in using its inventories to generate sale. The firm average collection period is 38 days, where the lesser day is the better. If the firm ratio is less than industrial average, this indicates the firm could recover back the cash from its credit sale quicker. The firm total asset turnover is 2.4 times. The higher the better. If the current ratio is higher than industrial average, this indicates the firm able to generate high sale with small amount of investment on asset. The firm fixed asset turnover is 8.3 times, where the higher the better. If the firm ratio is higher than industrial average, this indicates the firm is able to generate high sale with small amount of investment on fixed asset. The firm debt ratio is 67.4%, where the higher the percentage, the higher the risk. This indicates 67.4% firm assets are financed by borrowing. High borrowing means high interest payment. If the firm ratio is higher than industrial average, the firm will have higher interest payment. The firm debt to equity is 4.9%, where the highest the percentage, the highest the borrowing. This indicates 4.9% firm capital are from borrowing. If the firm ratio is higher than industrial average, the firm will have higher interest payment, resulting to less profit and lesser profit received by the shareholder. The firm time interest earned is 37.7 times, where the highest the better. It indicates that for every 1 ringgit interest borne by the firm, it has 37.7 times of EBIT earning before interest tax to pay for it. If the firm has highest time interest earned by industrial average, the firm has enough margin of safety. The firm gross profit margin is 37.9%, where the highest the better. If the firm ratio is higher than industrial average, this indicates that for every 1 ringgit sale, the company is making profit of 37.9 cents after deducting direct costs. The firm operating profit margin is 12.9%, where the highest the better. If the firm ratio is higher than industrial average, it indicates that for every 1 ringgit sale, the company is making profit of 12.9 cents after deducting direct and indirect costs. The firm net profit margin is 9.7%, where the highest the better. If the firm ratio is higher than industrial average, this indicates that for every 1 ringgit sale, the company is making profit of 9.7 cents after deducting all costs. The firm return on asset is 23.2%, where the highest the better. If the firm ratio is higher than industrial average, this indicates that for every 1 ringgit invest in asset, the company able to generate a profit of 23.2 cents. The firm return on common equity is 71.3%, where the highest the better. If the firm ratio is higher than industrial average, this indicates for every 1 ringgit invested by the shareholder is in the company, they are able to get a profit of 71.3 cents.
In liquidity ratio, there are current ratio, quick ratio and net working capital. As to compare between FNN and Dutch Lady, FNN have higher current ratio, quick ratio, thus higher net working capital. This means that FNN is more liquidity than Dutch Lady. Higher current ratio means that it has enough current asset to pay for its current liabilities. Higher quick ratio means FNN has enough current asset without considering few liquid asset to pay for its current obligation. And higher net working capital in FNN indicates that it has sufficient margin of safety and will be able to meet its short-term obligation. So as for Dutch Lady, it is vice versa that I said before. As to continue, in activity ratio, there are inventory turnover, average collection period, fixed asset turnover and total asset turnover. So from the table we can create graph so we could see the trend. So from the graph which it shows that Dutch Lady have higher value in inventory turnover, fixed asset turnover and total asset turnover, while it has lower value in average collection period as compared to FNN. So higher inventory turnover shows that Dutch Lady is efficient in using its inventory to generate sales, and higher fixed asset turnover indicates that Dutch Lady can generate high sales with small amount of investment on fixed asset. And higher total asset turnover indicates that Dutch Lady can generate high sale with small amount of investment on asset. The lower value of average collection period for Dutch Lady, it indicates that fewer days for the firm to recover back the cash from its credit sales. Next, in leverage ratio, there are debt ratio, debt to equity ratio and time interest earned. From the table, we can plot the graph. So it shows that Dutch Lady has higher value in debt ratio with 67.4% as compared to FNN. So the higher debt ratio means or indicates that 67.4% of the Dutch Lady asset are financed by borrowing. Next, FNN has higher value in debt to equity ratio with 7.1% as compared to Dutch Lady. So higher debt to equity ratio means that 7.1% of FNN's capital is from borrowing. So high borrowings means high interest payment. This will lead to less profit as well as less the profit received by the shareholder. Then FNN also has higher value of time interest earned with 47.1 times as compared to Dutch Lady. Higher time interest earned indicates that for every RM interest borne by the FNN, it has 47.1 times of EBIT, or known as adding before interest tax, to pay for it. So Dutch Lady has enough margin of safety. This comparison means that Dutch Lady is more value in debt ratio, debt equity ratio, and times interest earns. Last but not least, let's discuss about in profitability ratio. There are gross profit margin, operating profit margin, net profit margin, and return on asset and return on common equity. Okay, from the table it shows that for the table we can plot the graph, and then the graph shows that Dutch Lady have higher value of gross profit margin, operating profit margin, return on assets, and return on common equity, while lower value of net profit margin as compared to FNN. Okay. Higher gross profit margin indicates that for every RM sales, Dutch Lady is making a profit of 37.9 cents after deducting direct costs. Higher profit margin indicates that for every RM sales, Dutch Lady is making profit of 12.9 cents after deducting direct and indirect costs. While higher return on asset indicates that for every RM invested in the asset, Dutch Lady can generate a profit of 23.2 cents. Then higher return on common equity indicates that for every RM invested by the shareholder in Dutch Lady, they can get a profit of 71.3 cents. So in net profit margin, FNN shows a higher value of 11.6% as compared to Dutch Lady. Therefore, it indicates that for every RM sales, FNN is making a profit of 11.6 cents after deducting all costs.
In conclusion, financial ratios include the liquidity ratio, leverage ratio, activity ratio, and profitability ratio. In liquidity ratio, there are current ratio, quick ratio, and net working capital. Each of the ratio, the higher is better by means the company will be more liquidity. There is a trend ratio for FNN from 2017 to 2019. The trend shows that there are a decrease of current ratio and a decrease of quick ratio from 2017 to 2019. Net working capital for FNN from 2017 to 2019 shows an increased trend. In activity ratio, there are inventory turnover, average collection period, fixed asset turnover, and total asset turnover. Each of the ratio, the higher is better except for average collection period. The lesser days is better. There is a trend ratio for FNN from 2017 to 2019. The trend shows the inventory turnover is constant from 2017 to 2018 and later increased in 2019. Next, the financial ratios for Dutch Lady can be calculated to analyze its performance. The obtained ratios are compared with FNN, and the result shows that Dutch Lady have higher value of current ratio, quick ratio, and net working capital in liquidity ratio. For each ratio, the higher is better. In activity ratio, Dutch Lady have higher value of inventory turnover, fixed asset turnover, and total asset turnover. For each ratio, the higher is better. FNN has lower value of average collection period, which means the less is better. Dutch Lady shows the higher value in debt ratio with 67.4% as compared to FNN. Next, FNN has higher value in debt to equity ratio with 7.1% as to compare with Dutch Lady. In net profit margin, FNN shows a higher value with 11.6% as compared to Dutch Lady.
As for the recommendation, the company should have enough current asset to that it can pay for its current liabilities and increase the current ratio. The enough of current asset can also enable the company to pay for its current obligation and increase the quick ratio. The company should have sufficient margin of safety because it will enable them to meet its short-term obligation. The company should decrease the debt ratio debt to equity by decreasing the borrowing because it can lead to a low interest payment. The lower the debt ratio, the lower the risk. Average collection period of a company should be lesser so that the company could recover back the cash from its credits and more efficiency rates. The company should increase its of profitability ratio because the higher is better.